Well, thank you everybody for being here on a Thursday evening in our ongoing Money Matters series. This is the second of 2021. And today we're going to be talking about prepping for taxes. Just when we thought that 2020 was behind us, we still have one last lingering thing to take care of to finally say good riddance to 2020, and that is our 2020 tax return. So today we're going to be covering some of the changes that you can expect to see or deal with in this current tax season for 2021. I just want to, in terms of full disclosure for the presentation, mention to you that I am not a licensed CPA. I am not a tax advisor. I cannot crunch your tax numbers. So in terms of very specific tax advice, you need to see a tax pro for that. So a CPA, a licensed accountant, you may sometimes have taxes done by what they call an enrolled agent, meaning that they are an enrolled agent with the IRS. They are licensed to do your taxes, even if they're not a full fledged CPA. Okay, so what I'm going to be providing this evening to you is general tax advice about what to expect here in 2021 as you work on your 2020 taxes. Okay, so there may be specific questions that you have that I might not be able to address directly, just simply because I'm not a licensed CPA. So I just wanted to get that out of the way at the beginning. So in terms of the big picture, if you want sort of the bottom line for 2021 filing your taxes, okay, there's three things. Number one, the tax deadline has gone back to April 15th, 2021. Your 2020 taxes are due on April 15th. So last year, when we had the pandemic spreading and COVID breaking out and so on, they gave us a timeline break and they extended the due date of our tax returns, if you remember, into July, into the summertime of 2020. This year, what they're communicating, what the IRS is communicating so far, is that your federal returns, your state returns are going to be due by April 15th of 21. Okay, so we may experience an extension again. They may push back the deadline just depending on how this tax season goes. If you remember in our last session 2 weeks ago, I had mentioned that the IRS was not even going to begin processing returns until just a couple of days ago on February 12th. Normally, those of you that are just raring to go to get your taxes done, you're trying to get them done by the end of January, beginning of February. Even if you sent them in, the IRS wouldn't have started processing them until the 12th. So even they are sort of, after this year of COVID, are running on fumes in terms of manpower and processing because they had to process all the stimulus payments and so on. So we may even see this year an extension on the April 15th deadline. But as we know of it right now, tax day is April 15th, okay? Something is changing about standard deductions. Our standard deductions for 2020 are increasing for both single filers and married couples filing jointly. And I'll show you a table on that in just a little bit. But just for the big picture, just in case you want to listen to the beginning and then hop off, you'll know that our standard deductions have increased for inflation, right? So what that means then is on our taxes, they're allowing us to deduct even more than in previous years, right? Which is a good thing. And so we'll talk about the difference between an itemized deduction and a standardized deduction here in just a little bit. But just know that that's increasing by several $100s. And income tax brackets are also being expanded to account for inflation as well. So you'll see those amounts going up by several $100s in each bracket. And I'll show you those brackets here in just a little bit. Those are the main three things that if you had to take away anything from tonight's presentation, it's tax deadline, April 15th. We're increasing the standard deductions, and the tax brackets are being increased for inflation as well. Everything from here on out about 2020 are a lot of minor and very sort of specific kinds of tax issues, items, and questions. Okay, so let's get into what potentially those could be. Let's talk about the brackets first. Okay, so just a refresher on how income brackets and tax rates work, right? Your tax rate is the percentage of your income that you pay taxes on, and that percentage is based on a bracket, right? And those brackets look like this. So these are the tax brackets for 2021. I didn't put this into a table, but you can sort of see the columns there, right? Mm-hmm. So our tax rates, or the percentage of tax that we pay on our earned income, goes up based on the more income that we generate, right? So the first column there after the marginal tax rates is the single tax bracket. So if you're a single income tax filer and you make between $0 and $9,875, that amount will be taxed at 10%, right? It goes up higher if you're married filing jointly, because maybe there's two people working and generating income. So from $0 to $19,750, that is taxed at 10%. And so you could see there that as you go down those columns, the more money you generate, the more money that you earn, the larger percentage you will pay in federal income tax. Now, let's take an example for a second, just to understand this even better. Let's say we make $50,000 a year and we're a single tax filer. Okay, $50,000 would put us in the 22% tax rate category. I just want to be clear that just because you made $50,000 does not mean that you're going to, all of your money that you generated is going to be taxed at 22%. The way it works is the first $9,875 is taxed at 10%. And then above that, the next amount between $9,875 to $40,125 is taxed at 12%. And then finally, the last remaining amount to get to our 50 of earned income, say that additional 10,000 is taxed at 22%. So it's a blending of these rates, right? Okay. So each sort of portion of what you make is taxed at a different rate. Okay, so what they did this year is they expanded these brackets, right? Which means that the more money you're making, it could potentially keep you in that same tax bracket without you having to move up another tax bracket and paying even more tax. So bottom line is, by expanding the tax brackets, it's perhaps keeping some of us from being bumped up into the next tax bracket and paying overall, on average, a higher tax rate. Okay? That's the tax brackets. Like I mentioned before, they also are giving us higher standard deductions in 2020. So there's two ways that you can do your deductions on your taxes. The first way is to itemize them, meaning this is more work, it's more hassle, but to itemize, you are going to calculate all of your deductions one by one to see if you can deduct more than the standard deduction. So let's say if I'm single in 2020, the standardized deduction is $12,400. So I can automatically deduct from my taxes from my taxable income, $12,400 that I don't have to be taxed on, right? Now, if you itemize, you would have to one by one find enough deductions to get above that 12,400 in order to itemize your deductions. And most of us just don't have enough deductions, right, to deduct more than that standard. Right. So most of the time, most tax filers will just not do itemized. It's too much work. I can't get to that amount anyways. And they'll just go with the standardized deduction. So again, they've increased that by a couple $100 over last year, right? You can see that all the way down from single to married filing jointly and so on. So it's giving us the ability to deduct more off of our taxes, right? Yay. So that's a good thing.
Hey, Brian, really quick question.
Mm-hmm.
What's the difference between head of household and being like a couple sharing the responsibilities?
Yeah, so typically head of household is used for tax filers who are separated or divorced. Oftentimes, if a couple is married, but they are filing separately, oftentimes, and again, this is where a licensed CPA would come in to determine this, but oftentimes CPAs will determine that it's more tax advantageous for a couple to not file as married filing separately, but one of them filing as head of household, meaning they have children as dependents who they're deducting, and then their spouse is filing as single separately.
Oh my goodness.
Yeah. So that's when head of household might come into play when we're talking about a couple, right? So maybe the wife is filing as head of household and she has the children listed as her dependents, and then her husband is filing a single tax return. Sometimes that's done in order to save on taxes, but that is the magical work of a CPA.
Right. Oh yeah.
Yeah.
Because it's not something that normal. Like I have a friend of mine who does her own taxes because she does a lot of freelance work. Mm-hmm. And she can't really afford to have a tax preparer, so she would do it herself, and she's pretty good at it too. Mm-hmm. But it's like unless you understand this, like you're like us, you teaching us right now. It's like who would knew?
Yeah. And I will say to that point though, Vivian, that for individuals who use tax prep software, let's say you use TurboTax, Intuit, there's a number of online tax software. Mm-hmm. What those software programs will do is they will ask you questions about your household situation, mm-hmm. and then best determine what your filing status should be.
Oh, neat.
So even somebody who is doing their own tax returns, if they go through those series of questions, the software may help them determine that, well, based on how you've responded to these questions, it may be best for you not to file as single, but as head of household. And mm-hmm. so oftentimes the software can lead you to the right conclusion as well.
Oh, wow.
Yeah. So that's helpful.
Yeah, because I'm a single person with no children, no responsibilities, like no dependents.
Oh yeah, most of the time, then it's going to be single filer.
Yeah.
Yeah.
Okay, yeah. That makes a lot more sense because I was so confused when I saw my tax thing. Say what?
Yeah.
Head of household of what?
Yeah, exactly. Some more specific items that we should consider to possibly claiming on your 2020 tax return is the first one is charitable deductions. So when the pandemic hit and the government came out with the CARES Act, that's how we got our stimulus checks. That's how they made some other changes that we'll talk about here in just a second to our tax situation. The CARES Act now allows someone, I mean, if you give like nobody's business, you can deduct literally up to 100% of your adjusted gross income. Wow. But I don't think any of us are in a situation during this pandemic where we were able to charitably give as much as our adjusted gross income.
Yeah.
Okay. But also with the CARES Act, it did add a new deduction. It's what they call an above the line deduction that you can write off if you're taking the standard deduction, like we just talked about. You can write off up to $300 of charitable contributions you made in cash.
Wow.
Okay, so let's say you take the standard deduction, so you're not itemizing everything. It will allow you above that to write off an additional $300 if you donated that, right? Now, you can't just make that up. You would have to have tax evidence showing you made a charitable contribution. So the organization will send you, just like you get a W-2, just like you get a 1099, the charitable organization will say, thank you for your contributions in 2020. You donated $200, right? Well, that $200 can now be written off if you're taking the standard deduction. So that's good too. So again, we're giving, and yet now the government is also being gracious to us and allowing us to get some of that back. Because the government was wanting to encourage more charitable giving. Second thing is medical deductions, okay? So in 2020, if you spent time in the hospital, if you found yourself with some hefty medical bills, we may end up coming into some tax relief for you. So what you can do is you can deduct medical expenses that are above 7.5% of your adjusted gross income. Okay, so for example, let's just use even numbers for easy math. Let's say we had an adjusted gross income of $100,000. Okay, so we can deduct out-of-pocket medical expenses that are above 7.5% of 100,000, which is 7,500. We can deduct expenses above 7,500. Okay, so obviously, if you were paying for prescriptions out of pocket, if you had a procedure, if you made 100,000 and your total medical expenses did not exceed 7,500, that's 7.5%, you can't write those off. So this is really sort of for some pretty hefty, healthcare related bills. Okay. But let's say you were hospitalized and you, even after insurance, you still had 10,000 out of pocket that you were on the hook for. That portion above 7,500 could be written off. Do you have to worry about the math of all this? No. What I'm more concerned with for you is that you understand what to be looking for as possible write-offs and deductions, right? So let's not worry so much about the numbers necessarily. Let's actually just worry about the kinds of deductions and credits you can get, right? So number one, charitable deductions. So you can sort of think back, did I donate? Did I give cash? Did I donate some stuff to Goodwill? Did I get a tax receipt for that? Did I have high out-of-pocket medical expenses? Oh yeah, that's right. Brian said I can deduct these things. That's what we want to be looking for. Number three, in 2020, if you were self-employed, there are obviously a bunch of deductions you can claim on your tax return. Travel expenses, your cell phone. If you have a home office, you can try to get the home office deduction to use, part of your home to conduct business, right? But I want to pause here and say, oh, Brian, COVID, I had to work remotely. I was working at home. Can I get the home office deduction? No. Oh. Sadly not. If you're one of the millions of workers who were sent home to work remotely, you won't be able to claim the home office deduction because you have to technically be self-employed only. Oh. Yeah. You have to be self-employed. So if your company said, don't come into the office, just do your job from home, you can't claim the deduction. You have to, legally be self-employed. And even though you're working at home, you're still technically W-2, and that's not self-employed. Number 4, look out for the earned income tax credit. Earned income tax credit is a refundable credit for low and middle income workers. Okay, so workers that earn up to $56,844 could be eligible, right? And what that means is the credit can save you anywhere from a couple hundred to a few $1,000s, depending. It's just a credit that is given to you on earned income. If you're using software, it will walk you through to find if you have earned income. If you use a CPA, ask them, hey, did I qualify for the earned income tax credit? Because I definitely made under 56,000. You may be able to get that, okay? The IRS says that on average, about 1 in 5 taxpayers who are eligible for this don't claim it. They just don't know about it. They don't know to ask about it. So just don't let that be you, okay? Ask about earned income credit. If you have children, right? If you have a family, you can claim up to $2,000 per qualified child with the child tax credit, okay? Now, that income, there are income limits that phase you out of this credit. So if you're single and you have kids, once you make over 200,000, they phase you out. Married couples, 400,000, they phase you out. Okay. Child tax credit. Also, too, I should mention too, also be on the lookout for if you're having to have daycare for younger children so that you can go and do your job. You can go to work. There's deductions and credits for that too, right? So make sure that you're maximizing these. Let's talk even more specifically about the impact of coronavirus on our tax returns for 2020.
Yes, let's talk about that.
Yeah, let's talk about that, because that's where a lot of people's sort of specific and most popular questions are coming from, right? So first and foremost, we all jumped for joy when we got the stimulus payments, okay? So as part of the CARES Act, right, that initial round of payments, all of us adults got $1,200, okay? It might have been direct deposited to you. Maybe it was given on a like a debit card, quote unquote debit card. Good news, your stimulus money will not count as taxable income. Okay. So the way that the IRS is viewing this, based on the way that the government set this up, is it's being treated like a refundable tax credit. So basically what that means is it's sort of like they gave you an advance, right? And they're not taxing you for it, right? So that's a good thing. If there are any of you out there who under the CARES Act are small business owners and you took a PPP loan, which stands for a Paycheck Protection Program loan, okay? If you paid eligible expenses from those loans can be deducted from your taxable income. So that's good for small business owners. But all of those loans had to have been approved. It had to go through SBA loan approval and so on, so that you could be off the hook for what you borrowed. Here's another big popular question. What if I had to claim unemployment during COVID? For a lot of folks, it was their first time going through that process. And it is their first time dealing with unemployment benefits, right? So a lot of Americans found themselves out of work or temporarily out of work during the pandemic because of those immediate shutdowns. Those who received unemployment benefits you have to pay income taxes on that money. That is taxable income. Okay. So if you were thinking, great, I got a stimulus check, it's not going to be taxable. Great. And now I'm getting unemployment, even better. That won't be taxable. No, it is taxable. Unemployment is taxable. Okay. When you were taking your unemployment benefits, if you chose to get as much out of that as possible and maximize those dollars, and you chose not to have taxes withheld, you're going to be on the hook for them. And you're going to either have to pay them in quarterly taxes, right? Or you're going to have to set aside enough money to pay those taxes come tax day. Okay. So unemployment, hopefully you withheld, right? Maybe you didn't get the full amount, but you withheld taxes, right? So then you won't be on the hook for it because it is taxable income. Okay, let's talk about number 5, retirement plans. Let's say you got the stimulus check, you had to get some unemployment, and then to make ends meet, you had to cash some money out of an IRA, a workplace retirement account like a 401k. Well, a couple of benefits. The CARES Act allows you in 2020, because of COVID, to take out up to $100,000 out of your 401k, out of an IRA, and not pay the 10% IRS penalty if you were younger than 59 and a half. All right. So let's say I took some money out of my IRA last year to, pay some bills, or maybe I had to pay the rent just to make it through. CARES Act is not going to allow the IRS to penalize me the 10% because I pulled out of my IRA early. However, I will still have to pay ordinary income tax on what I pulled out of that IRA or that 401k. Okay. So the money is still taxable. They just did away with the 10% penalty. Okay. For those of you that are 70 and a half, that's when required minimum distributions from your retirement accounts begin. The IRS forces you to start taking monies out as income because they want to tax you. They want to get their tax money. They, under the CARES Act and the Secure Act, they pushed the 70 and a half age limit to now 72. So you weren't forced in 2020 at 70 and a half to take monies out. You could have just kept it in your IRA. You could have just kept it in your 401k if you didn't need to use it. Okay. And a lot of times there are seniors who are in a situation where they're getting some sort of other pension, they're getting some Social Security, and they don't want to have to take more out of their IRA because they don't want it to be taxed. Well, now this pushes the age limit to 72 instead of 70 and a half. Okay. One other thing I should mention too is that if you did take monies out of your IRA or your 401k, they're giving you the opportunity to put it back in. And they're giving you up to 3 years to put it back in. So let's say I took out $5,000 out of my IRA. I would be taxed on that as ordinary income. But if I put that back over 3 years, I can get what I was taxed back over time. Right? So again, just to explain that more clearly, because I sort of stuttered there. If I took out $5,000 from my IRA, I paid ordinary income tax here in 2020 on it. I have up to 3 years to put it back if I want to get my taxes back from it. Okay. Most of us, we're taking those monies out because we don't have it and we need it. We need the help. So if you're not in a situation to put the money back over the next 3 years, I mean, that's it. You were taxed on it. That is what it is. But the IRS is giving us a break and saying, look, you probably took it out because of hardship. You took it out because of an emergency. We're going to give you 3 years to put it back. Okay. So that's sort of the specifics as it relates to coronavirus. But let's sort of go one level deeper and just make sure that we go back through this again, right? Will my stimulus check be taxed? No. Will my unemployment benefits be taxed? Yes. Okay. I took money out of a 401k IRA. Will it be taxed? Yes. Will it have a 10% penalty if I'm younger than 59 and a half? No. But I have over 3 years to put it back if I want to get that taxable amount back that they took out in taxes. Here's another sort of popular question that keeps coming up. I keep hearing a lot. Brian, I had to supplement my income. I just wasn't making enough. They demoted me down to part-time, or they reduced my hours, or I was furloughed. I had to take on side jobs. Will that income be taxed? Well, of course, you know the answer. Yes, it should be taxed. So if you were running around doing Uber Eats, or you were making pharmacy deliveries for a company, you took on that side gig, whether it was one, whether it was 3 of them, because you had to do what you have to do, those freelancing and those odd jobs will be taxed. Okay. So you're going to owe regular income taxes on that money, right? Plus, because you were now doing self-employment work, you should also have to be paying self-employment tax, which is an additional 15.3%. What is that tax for? That's what goes into Social Security and Medicare, right? So if you made more than $400 in self-employment income for the year, yep, you're going to have to pay that self-employment tax. But remember, if you're self-employed, there's going to be a lot more that you can write off. So maybe in delivering those groceries, in those prescription drugs and so on, you're going to write off your mileage. You're going to write off your vehicle. Part of your job was using your cell phone. You're going to write your cell phone off. There's going to be other related expenses that can help reduce what you owe from some of these side jobs. If you don't receive 1099s or tax forms reporting what you made in those side jobs, you should have been doing your own bookkeeping. So if somebody was paying you cash, okay, technically you're supposed to be keeping track of that. And then as a part of your returns, filing that self-employment income that you made in 2020. Okay. So a good rule of thumb going forward is, so that this doesn't sort of bite you at the end of the year as you start prepping your taxes, is from what you make over the course of, let's say 2021, let's say you get some more side gigs or you do more self-employment income, set aside 25 to 30% of each dollar that you make, so that at the end, if you happen to owe, you've got something set aside to pay that tax bill, right? So a lot of self-employed make the mistake of going, wow, I'm just making pure profit, dollar after dollar after dollar, and not setting anything aside, right? They don't have an emergency fund, a cash reserve, or a cushion. They spend that money and then, oh no, now I got to do my taxes and I actually owe on all that side gig income and I've got nothing to pay the tax bill with. Okay. Yes, the IRS will definitely let you pay quarterly taxes, let you pay in installments and so on, right? But even that could be difficult if you haven't set the money aside. One question, in addition to number 5, I work from home. Can I claim the home office deduction? Yes, you can if you were technically self-employed. But if you were just working remotely, no, you can't. I tend to get the question of, I'm working remotely, but from a different state. A lot of people during this pandemic, they moved. So I don't want to stay in LA, pay the high cost of living expenses here in LA. I'm going to keep working for the same company, but now's my chance to move out of state. So they're working remotely from another state. So the question comes up, how is this going to impact my taxes? I'm living and working from one state, but I'm earning that income from another state where my company is based, right? So each state, and again, here's where a licensed CPA tax accountant is going to pay off, is if that's your situation, they're going to know how best to handle this situation, because every state has its own set of rules, okay? Most states have income tax, state income tax, and they will impose them on anyone doing work in their state, even if they're just passing through, even if they're working remotely from a different state. I've seen people with situations where they're paying state income tax in 2 different states because their work crosses sort of those boundaries, right? I saw one amazing stat the other day that during COVID, approximately 600,000 New Yorkers in New York City moved out of the city because they realized, man, I can do my job remotely. And they left. A lot of them going not just upstate, but out of state, right? So if that's your scenario and you relocated, you may just want to, as you get into prepping for your taxes, understand, how's this going to all work if I'm living in one state making income, but my source of income is coming from another state, okay? Just a heads up on that. A question that I've been getting as well is, what if I'm, during the last year in 2020, I tested positive for COVID-19 and I have medical expenses. Can I deduct those? Well, it sort of depends, right? We did talk about the IRS letting us deduct medical, dental, and health expenses above that 7.5% of adjusted gross income, right? The thing is, though, that in order to get to that 7.5%, you may have to forego the standardized deduction and try to do an itemized deduction, right? Which may make it difficult for you to do. So if your expenses were related to medical situations due to COVID, you may have to itemize your deductions and get enough deductions to get above that 7.5%, right? So as of right now, there are no special deductions because of costs related to COVID. It's all just sort of lumped together in your overall out-of-pocket healthcare costs. So yeah, God forbid that you had to go through treatments, somebody in your household was hospitalized. There's nothing specifically in IRS tax code related to special deductions due to COVID. It's all going to be lumped together in with your overall healthcare costs, but you got to get to that 7.5% above adjusted gross income, which may mean that you have to itemize things. And that'll just mean some more work in terms of filing. So based on the first 2 months of the year, that's sort of a lot of the questions that I've been seeing here early on. These are sort of the big things to be looking for as we're about to turn the corner into March. So again, if you have specific tax questions, see a licensed CPA, a licensed tax professional, an enrolled agent, somebody who can help you actually crunching the numbers, right? And to that end, I want Christina to just sort of plug a connection that Family Promise of the Verdugos has with H&R Block, which may be a way to help you. And then we can always get you other tax help, free tax help as well.
Thanks, Brian. So we have coming up, not exactly sure of the timeline, the exact date of the start, but H&R Block is offering our BHC residents that do their tax preparation and filing through them a $20 discount for their services, just across the board, whatever you end up, whether it's $50, $100, whatever it is, it's $20 off. You would just use a special code, obviously generated, so they knew to give you the discount. Like I said, I'm not exactly sure. It could be early next week or the end of next week, but be on the lookout for that information. If you're not already a member of the Facebook group for BHC, I suggest that you join. That's where you'll find most of the information regarding any workshops or updates. Sometimes, or Emily from BHC will send emails to you guys as well. But yeah, Facebook is definitely going to be the main connection for that. So I will keep you posted on that. Yeah,
Awesome.
We have 2 more Money Matters scheduled coming up for March 4th, Rainy Day Ready, prepping for financial storms. And then March 18th, Understanding Social Security Benefits. Just wanted to let you guys know, remind you of that.
Yeah. And then I think also too, Christina, layered in there, you guys are also ramping up other topics.
Yes, we're doing some life skills workshops. We're trying something new. We're going to do Kids Community Dental Clinic is going to come on next Thursday to talk about and discuss dental hygiene for children, or if you're a low-income family, you can get access free dental care, and they're right here in Burbank. So Dale from Kids Community Dental Clinic and Anna will be here. And then the next workshop, hopefully we're trying to get the H&R Block rep to come in on the 11th to talk about how you go about doing the process, especially when COVID, to get your taxes filed with them.
Okay, awesome. So yeah, I mean, that's been our goal from the very beginning, is to over time just put more and more and more and more resources together for the community, for participants in BHC, participants in Family Promise of the Verdugos. And so we really appreciate you guys coming in this evening after a long day of work, and see you again in the coming month. So thank you guys so much, and we'll see you soon.
Great. Thank you guys.
Brian.
Appreciate
Bye.
it. Thanks. Take care.
Take care,
Thank
everybody.
you.
Thanks.
Bye.
Thank you.